Welcome to today's webinar, in which we will have a look at the Forex markets, what happened in the past year, what may happen in the year ahead. We don't know what's going to happen in the year ahead, but we can certainly talk about what themes are going to be important and what market participants are going to be watching. I hope everybody can see the screen very clearly and that you can hear me. My name is Michalis Florentiades. I'm the Chief Economist here at xm.com. I'm also the head of investment research, and I will try to give you my insights and what do we think here at XM Investment Research, what is happening and what we should be focused on for next year, and certainly some insights into what happened. Some of it might not be so obvious of what happened in the last year. So, without wasting any more time, I would like to give you a brief outline. So, what are we going to talk about today? First, we're going to look at what happened during 2019 in terms of performance. So these are the figures. Obviously, if we had known at the beginning of 2019, 1 year ago, we would be very successful investors, but obviously no one knows about that. And I will tell you my comments on what should be interesting. Now, then we will look at the largest economy and the largest country in terms of most important country, the US, the Federal Reserve and its politics, a very important theme. Then we will go to the Eurozone, the Euro, and perhaps never-ending quantitative easing there. I guess the same can be said for Japan. The Bank of Japan, which is also still embarking on aggressive monetary stimulus and is in a struggle to avoid recession. The UK, which will be about Brexit and what Boris Johnson, the Prime Minister, plans to do about it, the victor of the latest UK elections. Then we will look at Australia and China, crude oil and gold, and then a summary going forward as well as some ideas. Now, what are the highlights of 2019? Well, the US dollar eked out again. It outperformed the euro. The British pound confound pessimists. It managed to rise. It had quite a volatile year, but it ended well for the British pound. The yen also did well, although it was a risk-on year and the yen is a safe haven, it did okay. But I would say that overall there was little volatility in major pairs. We're going to have a look at the performances in a second, but there wasn't so much movement. The Aussie, the Euro, and the Kiwi lost ground, but the Canadian dollar did very well, and indeed it was the best performer of the currencies that we are looking for. So as you can see, the pound managed to gain 3%. Also, we have the loonie managing to gain 4.5% against the US dollar. So USD CAD going down by 4.5% means that the loonie rose. You see the yen managing to beat the dollar by just 1%, but Euro, USD, Aussie, USD very close, losing between 2.5% and 3%. So in all, I mean, the biggest movement that we have on this chart, the two extremes, was the euro and the pound. Okay, I mean, you can take different combinations, but I'm just taking just indication. It was around 5.5%, but most of what we see here were between 1 and 3% for the major pairs. So that's what I mean when I say that there wasn't so much volatility. What happened for asset classes? Investments that people make, let's say. Well, Stocks were positive across all regions. There were central bank stimulus hopes, and indeed the Fed did deliver, cutting rates by 3 times. We'll look at that in a second. Developed and US markets were up nearly 30%, which was better than what emerging markets in Asia stocks did. They were up by almost 20%. Crude oil soared, WTI up 36%, and that was at the end of the year, not taking into account the latest tension in the Middle East. And gold found itself at 6-year highs at the end of last year, and now gold actually crashed through 8-year highs. So gold still doing very well, but a lot of volatility as well. So an exceptional year as all asset classes did well. So what does this signify? I think it shows that it was global reflation was there. So what does that mean? It means that money was being pumped into the market. There was plenty of liquidity, and a rising tide lifts all boats. So we had all asset classes rising. Oil, stocks, gold, bonds, even copper, they were all up, even soft commodities. So that's quite noteworthy, that all assets were up. That is not it's not common to see gold doing well, for example, which is a safe haven, but also stocks like the S&P 500 and the German DAX doing very well. On to the US economy. It slowed during 2019, so slower growth, but not as much as feared. It wasn't as bad as people feared. It was close to its long-run trend of 2%. We will have probably some deceleration of growth in the fourth quarter. We're going to get those numbers at the end of January. But if this trade ceasefire between the US and China holds, we should see better growth in first quarter. Job market continues to tighten, extremely low unemployment at 3.5%. This is a 50-year low for unemployment in the US. That's very, very low. Inflation is picking up. It's the core inflation, so that's inflation excluding food and energy, more or less, hit 2.4%. But the Fed said it's not worried about that. There was some impact because of the trade war. So we have manufacturing finding itself in the doldrums, but this deal between US and China has the potential to lift the sentiment, the business sentiment that things are not going to go so badly. By the way, if anyone has any questions, you can write them in. I will try to answer them at the end. I will try to leave some time at the end to answer some questions. I might not be able to answer your questions during the presentations, but I will be happy to take a few minutes to answer some questions at the end of the presentation. Now, here you see that wage growth, which is average hourly earnings, it's surpassing inflation. So this means that US workers are doing well. They are increasing their living standards because their wages are outperforming inflation. Here you see GDP. Yes, some slowdown, but not disastrously so. But we do see this is a worrying sign that the manufacturing PMI, so this is the business sentiment indicator for manufacturers, it has fallen quite a lot, but this hasn't really translated into economic weakness for the US. Politics are very important in the US because we had the markets going up and down on what is going to happen between China and the US, whether it's going to be a trade war. Within days, we are expected to witness a signing of the phase one, the so-called phase one trade deal. So I think this is more or less like a ceasefire in the trade war. We'll see whether we're going to get a more permanent truce. Trump has hinted at a phase 2 deal, but we will see the compliance of the phase 1 deal. And is Trump going to, let's say, pick a fight with the EU now that he's more or less found some peace with China? I don't think that it's going to be a long-term thing, this trade war. But are we going to see tension between the US and Europe? If so, then this could be further stress on the European economy. And Trump is going to use the trade war in his re-election campaign for the 2020 presidential race. So this is indeed the most important event of the year, the 2020 US presidential elections. On to the Fed. You might remember in December of 2018, the Fed raised rates, but it was subsequently forced to cut 3 times in 2019. More or less as insurance, it said, but we had more trade tensions as well. The Fed promised not to raise rates, so I think it's a little asymmetric. The Fed is more likely to cut rates than raise rates at the moment. This turnaround in the Fed was maybe one of the most significant factors to help stocks rise to record highs. And you remember this very impressive performance that stocks had. We may get one more rate cut in 2020, according to the markets, and we'll see how this is going to affect the dollar, because yes, maybe the Fed, that sounds dovish, but we also have to see what the ECB, the Bank of England, and the Bank of Japan, when we are talking about measures, what they are going to do before we pass judgment. And you see, this is the Fed funds rate. It peaked at 2.5%, presently at 1.75%, and it's forecast to go a little bit lower in 2020. This is a chart of the dollar index. So this is an index made up of 6 currencies against the US dollar. But you can see perhaps that it has not been such a volatile year for the dollar index. It more or less stayed within a range. So maybe not as much excitement. And maybe it's interesting to note that the dollar peaked as trade optimism started to set in, and that we would get a deal between the US and China. So less worries, less need for the dollar as a safe haven and reserve currency, and maybe market participants taking on a bit more risk. On to the Eurozone. Economic growth in the Eurozone is sluggish. It's not doing really well. The manufacturing sector in Europe has been hit hard by the Trump's trade war. Why is this so, you may ask? Because Europe was not one of the participants in the trade war. Well, Europe does trade a lot with China, and it does European machinery, let's say, German machinery, for example, plays an important part in Chinese manufacturing. So this hit Germany. It didn't. Germany avoided a recession, but still there was a slowdown. Now, as we said, there is a ceasefire in place. This phase 1 deal. Brexit risks are also subsiding. We seem to have a path that is going to lead us towards Brexit. So this no-deal Brexit chaos threat is receding. So this is both positive for Europe. Headline inflation was pretty low. It fell to 0.7% in October. That's maybe even lower than Japan. That's a very low inflation, but it's on the way up. Yesterday's release of Eurozone inflation showed it at 1.3%. So inflation rising, but still far from the 2% target. Maybe with some tariff effects, and if oil prices continue to rise, maybe inflation is going to pick up a bit more. It's not very encouraging, the Eurozone outlook, and I think the only way, well, what the markets are expecting is some fiscal stimulus that can really be a game changer if it's going to be significant. But at the same time, there is little appetite in Eurozone's largest economy, Germany, for significant deficits and deficit spending. So although this is needed and this is certainly could boost the euro, it's not seen as very probable right now. So you see inflation, the efforts, I mean, since 2018, we have seen inflation being well below 2%. GDP growth has moderated, but no big disaster so far. And business sentiment is slightly, I mean, it has slowed down, but it's still in positive territory above 50. We had a new ECB president, Christine Lagarde. She replaced Mario Draghi. But before Mario Draghi left, he restarted quantitative easing, so buying Eurozone government bonds, and he cut the deposit rates to a negative 0.5, so negative interest rates in the Eurozone. For now, it seems that President Lagarde is waiting out waiting out to see what developments are going to take place, buying time, and she has ordered a strategic review of ECB policy, but at the same time, I think that Lagarde does stand ready to act if there is slowdown, although the weapons at her disposal are limited, we have to say, because ECB is already doing QE and is already employing negative interest rates. So what else can she do, or can the ECB board do? I'm a bit skeptical. And of course, Lagarde is going to push for more fiscal stimulus. Now, political risks have abated. So not as much political risk. I would say that probably the Italian risk is a little underestimated at the moment, because I mean it's quite relatively quiet in Italy right now, but we could get some revival from populist parties and some anti-EU rhetoric. We will see about that. We will also see how Brexit is going to play out. A crucial meeting today between Boris Johnson and the Commission President, the new Commission President, which you can see on your right of the screen. And we will see if the Eurozone economy is going to bounce back given this improved outlook. You see the euro dollar here. It's interesting because also here I am very tempted to say we didn't get much volatility. It was a relatively quiet year. Traders are tempted to call a bottom in the euro, just below the €1 dollar in euro USD, in the just below 1.09. But we have seen that the euro has some trouble holding itself above the 112 level. So I think it remains to be seen. Right now, I think it's still kind of rangy. Yeah, short term there is some positive momentum, but it still has to break some resistance to show that it's going to move higher. On to Japan. It had a good 2019, but we also had a sales tax hike on October 1st, so we're probably going to get a bad fourth quarter. Everybody's watching how households are going to hold up, and whether they keep on spending with respect to the sales tax. It's more or less stable. It's also a victim of the trade war because it does a lot of trading in Asia and with China. So there is some uncertainty in Japan still. These are the key indicators. This is household spending. You see inflation well below the 2%, and although we have aggressive stimulus in Japan, we don't have any pickup in inflation. Exports were negative for most of the year, so this is, I mean, it's an export powerhouse, Japan, but on the other hand, exports are dropping, so some weakness in exports. Not a good sign. I mean, this is a strong headwind for the Japanese economy. The Bank of Japan is still, it's employing a massive monetary stimulus. We will see whether it will have to do more for the moment. I think it's more or less sitting on the fence. We had a limited trade deal between Japan and the US, but I think we need for the trade environment to improve substantially for Japan to do even better. Geopolitical tensions are also a risk to the economy. We have Iran, we have the Hong Kong protests and demonstrations, and they could boost the yen, and also they could increase the oil price, and Japan is importing all of its oil. Now, recession risks in Japan remain elevated, and I think it's too early to rule further action by the Bank of Japan. And here is the dollar yen. Obviously, more gains by the dollar, and seeing dollar yen head above the 108, 109, 110 level is going to be a boost for Japanese exporters and for Japan. Conversely, if we see risk off and safe haven buying, 106, 105, we could revisit the lows of last year, and this could be detrimental to Japan. On to the UK. UK growth has been nothing to write back home about during 2019. It was all about Brexit, and this has also impacted the economy. There was a lot of political uncertainty, but following the elections, it seems that business confidence is rebounding, and the economy could improve a little bit in the first quarter, despite the somewhat negative effect that for sure Brexit is going to have on the UK economy, is my personal view in the short term, at least. So there is some return in confidence that at least we have a map of how we're going to get out of this Brexit mess. Inflation has fallen to around 1.5%. The Bank of England is in a difficult situation. Wage growth has started to moderate, and UK manufacturing also did rather poorly, but the services sector has been doing okay. Now, will the victory of Boris Johnson's Conservatives drag the UK economy out of the current doldrums? Remains to be seen. It's the big question for sterling. You see here average weekly earnings. It's on this side, left-hand scale, holding on relatively well. At the same time, retail sales have taken a little bit of a knock. So this is a little bit weak, and inflation also rather weak. We'll see whether there is a pickup there. And GDP growth has been uneven. It has been somewhat volatile, as has business sentiment around the neutral line of 50. Now, so Boris Johnson won a large majority at the December 12 election. The UK is going to leave the EU on January 31st. But at first we are going to have a transition period. Boris Johnson is trying to limit the length of the transition period by saying that in December 2020, UK is going to come out of the EU, and this is going to be, and the transition period will end. However, it's unlikely that a trade deal, a comprehensive trade deal, is going to be struck by December 2020. So although it's not, it's less risky, the Brexit process, so now we have somebody who can get things through Parliament. We are still not sure whether there is going to be some tough negotiating, refusal to extend, and so the threat of disorderly Brexit has receded, but it has not gone away entirely. And this could be a very big theme also for the pound. We will see. The pound could be the big winner in 2020 if the UK and the EU move closer and even reach a deal on the future relationship. But until then, there's expected to be plenty of bumps along the way. And my personal view is that at least Boris Johnson has showed some realism in striking that deal that he did back in November of 2019. So that bodes well for him eventually striking a deal with the EU. Yes, and we are going to look at. We are not going to do any technical analysis, by the way. We are just looking at a few charts. If there are any charts that you want me to go over again to look at in more detail, please leave it in the questions, and maybe I can we can have a look after the end of the presentation. The Bank of England, this is the new governor, so it's a new face. So because Mark Carney is going to leave in March, this is Andrew Bailey who is going to replace him. I think it's an open question what the Bank of England is going to do. It did turn slightly dovish towards the end of 2019. What does that mean? That it's looking to keep rates on hold or maybe even cut rates. So, but I think that the Bank of England is going to be cautious unless there is more clarity on Brexit, because it will be very reluctant to raise rates until we know what's going to happen with Brexit. While there is this uncertainty, I think it would be a huge gamble for the Bank of England to increase rates. Now, this is a very interesting chart because it shows how sterling, the roller coaster ride of sterling versus the US dollar. We had it initially rallied at the beginning of the year to around 133. Then, with all the troubles that Theresa May's government faced, etc., we had all this drop to the level of almost 120, breaching 120, and then after Boris Johnson took over, and then he concluded a deal with the EU, then he won the elections, the pound recovered massively, and this is a very, very impressive rally in the pound. It's not something that you see very often for major currencies, so indeed a roller coaster ride, and the pound provided most of the excitement for currency traders, at least during 2019. Now, on to Australia. Australia's economy has been slowing, and inflation has been missing the RBA's, the Reserve Bank of Australia's target band of 2 to 3% for the past 5 years. Wage inflation also subdued. Housing market has started to recover with the help of RBA cuts, but the economy is not looking so strong. Also, Australia very sensitive to this trade war as a commodity exporter, so very sensitive to what is happening in trade. The RBA cut the cash rate 3 times to a record low of 0.75%. It's an all-time low for Australian interest rates. And investors are expecting one more 25 basis point cut. Recent tax cuts have not provided much of a boost. We'll see whether easing trade tensions are going to help. And we will see whether it will be enough to sustain Australia's record streak of economic expansion. I have to point out here that Australia is one of the countries that has one of the best records in terms of positive economic growth. I'm not sure when the last recession was in Australia, but it has an impressive record in terms of managing to grow, even if lately there has been some weakness in economic growth, but no recession, of course. Now, there is speculation that the RBA may cut, and if there isn't an improvement in growth and inflation, the fires are also becoming a factor, and we saw some selling of the Australian dollar because I think this natural disaster that is occurring might be pushing the RBA towards a rate cut sooner than it would have otherwise done. So this is the RBA cash rate. We see cutting rates for the last 5 years. And you can see the Aussie was doing relatively well. It ended the year on a relatively high note. We said it was a loser for the year, but it did manage a recovery during December, but we see that it has faltered now. It's at very crucial support levels, and it's important to watch what is going to happen to the Aussie. On to China. China slowed down to 6%. All this trade dispute with the US is definitely hurting China. The government is also talking about maybe growth even below 6%, which would be significant for China because I think it has also been on a record streak of expansion, very rapid expansion. Consumer inflation spiked, but not really a worry right now. Exports, of course, have been struggling. It has been targeted by the US, so it has been facing higher tariffs. And there is, at the same time, stimulus from the People's Bank of China, so it's cutting benchmark interest rates and the reserve ratio requirement, so helping liquidity. There are also some concerns that the Chinese economy is over-leveraged, there's too much debt, so that's another issue to think about. But the yuan has been steadily appreciating as trade frictions have abated. There were negative pressures on the yuan, but for now they have been faced. Now, the phase 1 deal is soon to be signed and sealed. It will suspend additional tariffs and halve some existing tariffs. That was a key condition that the Chinese set in order to do the deal. However, this has not resolved the trade conflict between the US and China. There could be the temptation for President Trump to, let's say, pick on China once more the closer we get to the US elections, because I think that being tough on China is helpful with his base. So this is one consideration, and I think that's also it has gained some momentum. This anti-China sentiment, I think, in the US. So it could play out in the elections, although we want relative calm before the US elections, especially President Trump. It could be a topic that might feature in the campaign. Private company defaults have been on the up. This is what I was talking about, that we have excessive debt in China, over leverage. So this is a potential problem down the road, maybe not immediately, but down the road. And the outlook for China's economy is centered around the trade war. So if the trade war is resolved, then the hopes will rise that the Chinese economy is going to do better. If not, then Chinese economy is probably going to suffer, together with a lot of other economies. To be fair, it's not going to be China's problem. Here are the Chinese growth. What I want you to see, you see that during 2017, these bars are exports. So the exports in 2019, very, I would say, not particularly good performance, around zero, quite negative performance. And this is the manufacturing business sentiment. It dipped into negative territory, and it is in negative territory. It stayed in it for almost all of 2019. Here you also see the slowdown in GDP growth. Although it's at 6%, most countries would dream of having 6% growth, but the goals for China, the bar for China, is set relatively high. And this is the chart of the Chinese yuan, the dollar versus the yuan. This is an 11-year low above 7.15. So the 7, very important psychologically important mark, 7 yuan to 1 US dollar. So when the yuan falls, when dollar yuan goes above 7, it's something to take note of. Now, the best performer of the year, crude oil. WTI, the West Texas Intermediate, the US benchmark, gained almost 36%. Why did this happen? Well, we had some supply disruptions. You remember the rocket attack on the huge Saudi oil field facilities, which stopped production for a period. We have the sanctions on Iran and Venezuela. We are going to see in a second that these sanctions did have a significant hit on the oil production of the two countries. We have OPEC production limits, and of course we had the US-China trade ceasefire. It rekindled some optimism about oil. Now, looking into 2020, what happens with Iran is going to be very key. So if there is a conflict there, or there was actually today in the news that a lot of oil tankers are not going to sail through, will stop sailing through the Strait of Hormuz, so in the Persian Gulf. So this is, I mean, this I just bring as an example that it's an issue that a lot of oil, of course, is being pumped in that region. And while, okay, it is supplying, and there has been a smooth supply of oil, at the same time we could have, if there are problems, we could have spikes in the price of oil, as indeed we did right after the the rocket attacks against the US bases in Iraq, when oil rallied 4% earlier today, but then it gave up all those gains as it looked like the conflict was not going to be so widespread. So here is the chart of Iranian and Venezuelan oil. This is very, very interesting because Iranian oil production fell from 3.8 to 2 million barrels per day. So this is the blue line is Iran oil production, and this is the axis. So about 1.8 million barrels a day taken off the market by the sanctions on Iran from 2018 onwards, while for Venezuela, the red production from around 2.5 million barrels per day, it fell all the way to 700,000 million. So that's about 1.8 million barrels also taken off from Venezuelan supply. Gold shined in 2019. It had a huge, big rally also at the beginning of the year with the geopolitical uncertainty with the events in the Middle East rising to 8-year highs earlier today. What are the main drivers of the gold rally? Falling interest rates, fears of recession, geopolitical and political tensions and uncertainty, and some hedging. So for anyone who has significant gains in stocks, there is temptation to hedge by buying gold. Gold is seen as a good investment also in 2020 because the Fed might cut rates again. We might have seen a top in the dollar. So if the dollar drops, this is also going to be bullish for gold. And although we have had some positive developments in trade, in Brexit, we also see geopolitical concerns and some recession worries. What could hurt gold, on the other hand, if global growth picks up and if the dollar moves higher? So this could push gold lower. So this is quite interesting that although higher rates should be hurting gold, we can see that gold was not so inversely correlated as expected with interest rates. Intraday moves, of course, they were. Intraday moves, of course, we had this correlation, but at the same time, because this is inverted, so if we see falling interest rates, because this is inverted, this axis, we see rising gold. So this is an interesting chart which shows that falling interest rates make gold more attractive. Interest rate is a key determinant of the gold price. Finally, I'm just going to mention something about cryptocurrencies. We had this rebound in the Bitcoin, almost doubled in price, but huge volatility for Bitcoin. Facebook's Libra announcement cemented expectations that cryptos are here to stay. More retail investors adopted cryptocurrencies. They are being seen as an alternative investment, not as much as a currency, but as an alternative investment. We have seen some correlation between gold and Bitcoin, so some people think that Bitcoin is a safe haven, although I am less sure about that, but some investors do make that connection. The 2020 outlook is uncertain as ever. We are going to have a supply growth is going to set to halve in May 2020. So is that bullish for Bitcoin? Some investors may have front-loaded this already, and there is risk of increased regulation and central bank oversight. Overall, I would say that regulators are not on board the cryptocurrency train. That they really don't like cryptocurrencies so far. We are seeing them being quite strict, and this was also the case with Facebook's Libra. It received a very hostile reception by US regulators and European regulators. So we will see what is going to happen in 2020. Now, summary. I would say the key takeaway for me was that there was little to split among the majors during the year. What do I mean by that? There was not so much volatility and no huge moves. We spent, especially with respect to dollar, euro, pound, and yen, most of the year we are in pretty tight ranges. The US dollar hung in there. It managed to eke a gain. The yen did slightly better than the US dollar. If I was going to give you some winners, they were the loonie, the Canadian dollar, and the British pound. So, of course, the question is, are we going to get more of the same in 2020? A lot of times, for us economists, we are accused that we are always we're driving by looking at the back view mirror. So we are looking at the back view mirror and are forecasting what is going to happen. Obviously, it's not going to be, but it's important to know where we are coming from and what have been the key drivers so far. In terms of other assets, stocks had a superb 2019. It was really a huge year for stocks with gains of almost 30% for the S&P 500. People are usually they would be happy with gains of like 8%, let's say, in stocks. So getting gains of 29% is something really outstanding. And this optimism is still there because ahead of US elections, there is the argument that incumbents try to present the best picture possible of the economy, of the stock markets when they are going into a re-election campaign. So I would liken the stock market rally as a train that will not stop. And anyone who was shorting stocks really found out the hard way. Bond yields have recovered a bit, I think, with the positive news on trade and less negative interest rates compared to September. We had some better economic indicators, so that reduced the negative bond yields. So that's really an oddity of our times, negative interest rates. In commodities, oil and gold are shining, but others are not as strong. I would think that oil and gold have their own drivers. Oil more by supply on the supply side. Gold also because of its monetary features as a metal and also a store of value. But if we look at the copper, if we look at agricultural commodities, other industrial metals, we didn't see as much gains. That's because although there was no it wasn't so bad for the real economy during 2019. We didn't really see excessive demand, and maybe the trade war tensions had something to do with it, and manufacturing had some problems also. Now, some favorite trades and an update on some views going forward, I would say. The US dollar is looking like a tired bull. It has had a very long bull market. Maybe the Fed is looking easy. But if other major central banks are doing more easing, well, if anything, the dollar could hang in there. So I would say that people who are bearish on the dollar, I think should look outside the yen, euro, pound, let's say, maybe try to find alternative currencies to short the dollar against if they are. But I would be a little cautious because the US dollar, although it's not, it's looking expensive, but the US economy fundamentals are not so bad still to justify a major weakness in the dollar. And for example, let's take the euro. The euro, I say that it is waiting for the fiscal Godot, which is, for those of you who know the play Waiting for Godot, the main characters are waiting for Godot to arrive and he never makes it during the play. So this is a problem that if we are waiting for fiscal stimulus from the Eurozone and it's not there, then I don't see how the euro is going to perform very, very well. At the same time, I think that there is long-term value in the euro if we're looking at it at purchasing power parity. So if somebody is buying euros for the long term, I think it's not a bad deal. The pound is the markets. Oh, I would not say, but the FX markets darling maybe is a too strong a word, but it has been the winner. The rationale is don't try to short the winner. So the pound could see further upside. It's on a positive trajectory. If we get some positive news on Brexit, we'll see more gains. But I think it's still in for a bumpy ride because it's not exactly clear what the EU Britain relationship is going to be post Brexit. And I'm not only talking about the trade aspect, I'm talking about services as well and other key issues. The yen is not looking to be very exciting. I don't think it has much upside while things are relatively quiet. And what do I mean by that? I don't see a rally in the yen unless there is some major wave of negative risk appetite or falling stocks. Otherwise, I think that the yen is going to remain pretty flat. I don't think that I don't see a pickup in volatility. But I have been impressed that the yen did not lose a lot of ground while stocks were moving so positively this year. So it looks resilient, but I would not bet on much upside for the yen if things are continuing to go smoothly. Now, the loonie was another winner, as we said. It's good that the loonie is not doing, the Bank of Canada is not doing QE, and the Canadian dollar could also benefit from oil spikes. So overall, I would not be negative on the Canadian dollar. I think probably staying with the Canadian dollar is not such a bad bet in today's terms. Now, please get together any questions you might have while I show you that, of course, you can register for our platform to have a full view of our research offering together with Reuters News and with signals from AutoChartist and Trading Trading Central. Really a one-stop shop for your technical analysis and fundamental analysis research. We also visit our YouTube channel. And thank you very, very much. And now we go to have a look at some questions. I will do my best to try to answer this. Yes, I am at the difficult situation that President Trump is going to start speaking very soon, and I think predicting what President Trump is going to say is quite difficult, to say the least. But my view is that President Trump is going to try to go in the US elections in November with a positive economy, good economic growth, with stock market at all-time highs, and a good picture. So he will try to avoid a recession. He will try to first of all also not get involved into any foreign wars. Now, having said that, uh, sometimes people have goals which are not realized. So that's going to be his goal, and he's going to try. Whether he succeeds or not is another issue. But the market right now, I think, it believes that uh, he is going to, like ahead of the US elections, risks are not going to be so high. So I think this is a very key assumption by markets that there's not so much to fear either on the trade front, either on the US recession front, um, or on the geopolitical side. Now, how will Brexit affect the performance of the euro? It's an interesting question because if Brexit goes well, this is a positive for the euro too. It reduces the uncertainty of Europe with respect to an important trading partner such as Britain. So, if we have a smooth Brexit and a successful conclusion of UK-EU negotiations, this is one less thing to worry about for Europe. So it should help the euro, especially versus not against the pound as much. I think the pound is going to do better, but uh, than the euro in that sense, because Brexit is even more important for the UK than it is for the eurozone, for the EU. But it should help the euro vis-a-vis other currencies. Let's say the US dollar, or the Canadian dollar, or the Aussie, or the yen, etc. Now, with respect to gold, I think that one alternative uh, explanation of why gold is going up. One thing is the geopolitical uncertainty. Okay, this is very well known. So people are saying that gold is going up because we have tensions in the Middle East. Maybe we're going to get war. There's also uncertainty about trade. There's uncertainty about the economy. Let's buy gold. At the same time, there are some investors that are saying that uh, gold is going to benefit because central banks around the world have very low threshold for any kind of pain. What do I mean by that? Let's say that the S&P 500 falls by 10%. This could lead to situations like saying, like, oh my God, equities are falling. It's almost the end of the world. The Fed should do something. It should help us, central banks. Please print more money, flood the markets with money so that we don't. So I think this kind of sentiment is very bullish for gold because the more interventionist central banks are, the more gold is going to rise because there is this uh, temptation, let's say, to print more money to try to uh, keep markets up. But at the end of the day, what this could lead to is to money losing some of its value, and things like gold could gain in value. So uh, I mean, yeah, if things are all going well, and if monetary policies are going to be normalized and interest rates are going to go up, this will be bearish for gold. Okay? But as long as we stay with negative interest rates, QE around the world, and super activist central banks, then gold is a good hedge to have. not the best investment, but not, it's also a hedge, but just keep this in mind. Now, tomorrow's non-farm payrolls, I think we will have a positive number for non-farm payrolls. I think the US economy is looking relatively strong. I'm not saying too strong, but it is holding in terms of performance. And I think that this is the trade truce, let's say the trade war truce, is going to help the economies and give them maybe a short-term boost. Although this has been something that has been telegraphed so many times and spoken about so many times. Now, with respect to US and Iran, the tension of US and Iran, what is going to happen there? Well, and whether it's going to be to affect dollar and oil. Now, I don't think that primarily the US, but also Iran, are interested in a war. I think that President Trump has shown he's not interested in a war. And also Iran, it has also economic problems, it has domestic issues at home, instability. It also doesn't want a war with the world's most powerful military. At the same time, these are two entities, the US and Iran, that are picking on each other. So they are taking actions against each other. So I expect things to uh, be tense. I expect episodes like what we had with the killing of the Iranian general, with the missile attacks against the Iranian missile attacks against the bases. I expect the proxies of the two countries or their allies also to have tension and maybe conflict between them, but I don't see a direct conflict at the moment unless there is an accident between a big accident, and this cannot be ruled out. But this is like the main scenario. This is also what the markets believe, because you see immediate reaction when Iran launched the attack against the bases of US in Iraq. We had a very big move, but then it came back. So I think tension, high tension, yes. Some episodes, yes, but not a new war, uh, as long as this can be avoided. Now, what is going to happen to Euro USD since we are expecting election? I would say that I am not sure that Euro USD has bottomed at 1.09 or so. I think we could revisit the lows and break the lows. It looks to me that the Eurozone is in a little bit worse situation right now than the US. Despite the rally of the US dollar, I think it does have some more upside, judging by the economic performance that I see. And I think that the US overall, at this moment in time, is relatively more dynamic and flexible economy compared to the Eurozone. So we could see some further dollar strength. But again, I don't think that, I'm not saying that we're going to have a massive rally in the US dollar, because I think most of the gains of the dollar, if we look at where Euro USD was a few years ago and where it is now, dollar has been rallying quite hard. So we might be at the end of near the end of this rally, but I don't think that this is happening very soon. Now, The dollar is also rebounded since the beginning of the year. We had a drop in the dollar at the end of 2019, but then we saw some gains by the US dollar. I think this was more technical selling. So what do I mean by that? There wasn't real news about economic indicators and performances. This had more to do with end of year flows by either companies, by either some pretty big funds. So these are the main I think this was the main events that drove US dollar flows towards the end of the year, and not so much the what you call it some underlying fundamental development. Now let's see, we also have a question about the Mexican peso. Well, I have not seen so much. I mean, it hasn't been as volatile. I think has more or less been a little bit stable, but I think the Mexican peso also is benefiting a little bit from the stronger oil price, so it's one of the beneficiaries. Also, we have less uncertainty for Mexico following the trade deal between Canada, US, and Mexico. So like this new NAFTA kind deal is one thing that helped the Mexican peso, and definitely there is less of a threat right now of a new fight with the US. So there's less threat of a new fight between Mexico and the US, I think, in the short term and in the run up to the US elections. So I don't think that it's looking so bad, the outlook for the Mexican peso, but it also depends on the domestic developments and domestic political situation, which I cannot claim to know a lot about of what is happening internally in Mexico. Okay, if there is anyone who would like the presentation in PDF form, please let me know. I will be happy to send it to them. But I think that we have concluded our webinar. Thank you very, very much for attending. I hope it was something interesting for you. I don't know if you wanted more predictions, but you know, there is a lot of risk in trading, and what I am trying to do is identify the key trends and key themes and key scenarios of what is expected, and how to, and maybe to learn how to think about these events. I think this is more important than just giving a tip of what if something is going to go up or down. And with this, I would like to wish you a very happy and successful new year. All the best for 2020 to all of you. And I hope to see you soon in another webinar where we will look at what is happening in 2020 as it is getting on. Thank you very much and have a great day.